Please welcome to the stage Laura Fauchy from ADA, Noémie Régnier from Incofin, and Howard Miller from CGAP.
Hello. Good morning. It's still morning, I think. Everyone, I'm very happy to see that despite we are so close to this lunchtime, there is a crowded room today. So thank you very much for participating to this session. I'm delighted to be today with two experts that will share with me some interesting insight of positioning of financial inclusion in the impact finance sector. And I'm together with Noémie Régnier, that is partner and head of that at Incofin, and as well together with Howard Miller, that is consultant on climate adaptation and resilience at CGAP. My name is Laura Fauchy, and I'm the executive director of ADA. ADA is a Luxembourgish NGO that for exactly 30 years, tomorrow we are going to have our 30th anniversary, has been developing initiative in the financial inclusion sector, trying and with the aim to promote, facilitate the access to financial service to vulnerable people, and working in the strengthening of local partners. As you can imagine, 30 years ago when ADA started with supporting microcredit initiatives, microcredit program at that time, we concentrated our effort in strengthening institutional and with the governance organization that were pioneering in the microfinance sector at that time. But since then, I think that microfinance has, since the beginning, being part of the social finance sector, being part of this component due to this double bottom line approach. Since the beginning, microfinance combined this financial return expectation together with the social impact, the social mission that was fighting poverty rather than empowering women or providing to smallholder farmers microcredits. And this was the beginning of an history to which ADA promoted as well the way in which this social impact could be tracked, measured, with the participation, as Jürgen already mentioned, to the Social Performance Task Force that made a pioneer work on tracking outcomes and measuring outputs in the sector. Since 20 years, this sector is tracking, producing efforts in order to create tools, to create principles to not just do not harm, but even doing good. And I think it's very important to position that as social finance. I think I had, yes. But the evolution of the financial inclusion evolved. We have seen in the previous panel, we were talking with different asset managers that historically belonged to the inclusive finance and the microfinance sector, that we talk about impact. Because the evolution of financial sector is not just about providing a microloan to smallholder farmers is much more today. It's something that is providing different set and a wider set of financial services. Those services can go from create it and save it, but as well digital payment, digital wallets, microinsurance, pension schemes, all the set of financial services that are needed from low-income people. And there is a change as well in the last 10 years, at least 10 years, of the financial service providers as well that are in the field. We, at the beginning, started with strengthening microfinance institutions, but other actors enter in the market, like banking sector, traditional one, fintech, insurtech. Today we see that there is such a broader set of organizations that work in this space. And financial inclusion became, in this sense, a very key player, key driver of SDGs. So it's not just providing financial services or credit to a smallholder farmer in order to improve their revenues. It's much more than this. When we provide financing to a family in order to help them in paying scholar fees, we contribute in achieving an SDG like education for all, the SDG 4. When we help smallholder farmers in the ecological transition to smart agriculture, we help him in food security, for example. So all these financial services can help people in attending the SDGs in general. And it's not just about SDGs, it's as well today the component of climate and environmental responsibility that is so important in these days. And this is the reason why quite recently we moved from this double bottom line, financial returns and social impact, to a triple bottom line approach that aggregate this third component, that is the environmental and climate component. And this is quite easy theoretically, because the clients of microfinance institutions, of inclusive finance service providers, are the ones that are today the most vulnerable to the climate emergency, and are the ones that can be achieved and reached very easily compared to other initiatives. So there are the natural final beneficiaries of this new inclusive green finance. So this triple bottom line approach is becoming the main characteristic of the financial inclusive sector today, as we will see that in ADA. And so this is the reason why we put at the earth of the impact finance the inclusive green finance today, because it's investing with intentionality, with the scope to measure the impact, the social and environmental impact that we want to achieve. And there is this additionality due to the component of non-financial services. We mentioned in the panel before blended finance with the component of TA and capacity building that can help strongly in improve the set of financial services adapted for local people. So just to put the scheme and just a little bit frame about financial inclusion, impact finance and this important role that financial inclusion can play in achieving SDGs and the climate goals in particular. But we still remain with the challenges to face. The previous panel explained from the point of view of the asset managers quite well that are challenges to face today, and I absolutely happy about the fact that one of the most challenges is the scale. We still remain important, but small in our sector. This scale problem is challenge is can be seen from a supply side in terms of what can be offered from the investor's point of view and from the asset manager point of view as well, but as well from the demand side. And when we talk about demand side, we talk about measurement difficulties. We, in the previous panel, we're talking about data, for example, measurement of outcomes that still remain challenging and costly if we want to stay rigorous. So I open the panel with maybe starting with the demand side from the SIGA perspective.
Thank you, Laura. As Laura mentioned, I'm here representing CGAP. In case any of you don't know, CGAP is a think tank housed at the World Bank, made up by members from basically all the development sector organizations working in financial inclusion. CGAP's been thinking about this topic about financial inclusion and climate for a while now, but it comes out of a longer piece of work, a kind of an identity crisis that the sector had for really the past decade or so. This idea of financial inclusion for what, right? We've been working on financial inclusion for so long, but what are we actually doing it for? We had this very basic idea in the sector for years that people will have access to finance, people will use that finance in a way that improves their lives. And we had big successes, you know, microfinance, mobile money, digital finance, opening up access to people. But the problem was we didn't have that much evidence that people were using it, and we had even less evidence that people were using finance to improve their lives. So at CGAP and other organizations at the time, we did a lot of thinking about, so how do we build these bridges? How do we get people to use these services more? How do we get them to use them in a way that improves their lives? And you know, this coincided with a lot more evidence coming out from academia, but we had a good sense that financial inclusion can improve resilience, right? Access to a savings product, access to mobile money so you can get money quickly in an emergency, access to microinsurance. Pretty good evidence that financial services can boost resilience. Also quite good evidence that it can support opportunity and make economies more inclusive by giving opportunities to poorer members of society. So we, CGAP developed a new strategy that really focused on what can financial inclusion actually do in the real economy. It can promote resilience, it can make economies more inclusive, and what I'm going to talk about today, it can support green outcomes as well. And when you start thinking about the impact of how people use financial services, you start to get, like Laura was saying, to the SDGs. You realize how financial inclusion can support outcomes in nutrition and support food security by investing in food systems. And this is another area of work that CGAP is working on. As Laura said, it can also support investments in education, investments in sanitation and wash facilities by providing credit to communities to build these facilities. But, you know, the finance needs to be there, but it needs to be married to an opportunity to actually improve people's lives. But getting to the green part, we 3-4 years ago, we started doing this big R&D effort around what does the intersection of financial inclusion and climate actually look like. And here we're not talking about climate mitigation, right? We're not talking about how can the poorest people in the world reduce their carbon footprints, right? We're not talking about switching from carbon to clean energy sources, because there isn't much of a carbon footprint to reduce, right? The mitigation debate is very important but it's one to be had, you know, in rich countries, in, you know, investors in banks in the rich world. When we're talking about the customers of inclusive financial institutions, we're really talking about how do you cope with tropical storms? How do you cope with flooding? How do you cope with periods of extreme heat? How do you cope? How does a farmer manage when weather cycles are increasingly less predictable, and they can't manage those risks? Right? These are all, how do you cope with sea level rise in a coastal community? How is climate affecting people rather than how are people affecting the climate? And so we broke it down into these ideas of resilience. How do financial services help people become more resilient to climate shocks and stresses? How do they adapt? What are the investments, the changes they need to make to adapt to climate risks? And how do financial services help poorer people participate in the transition that we are going to see, whether we like it or not? So when we think about it like that, and we look at how financial systems work in poorer countries, it's pretty clear that they don't work at all to help people manage climate risks. They're not set up for it. They're not well established to do it. The capacity's not there. The capital's not there. The product's not there. Apart from some kind of institutions we see at the vanguard that are thinking about this. But when you go to an average MFI in an African country and you talk about green finance, they probably have a loan for solar energy systems, but they don't think very much about adaptation and resilience. But our research shows from speaking with hundreds of institutions that there are some types of institutions that think about this. Insurers think about it generally because it's an existential risk to their business model. We haven't found many banks that talk about it at all. We haven't found many MNOs or fintechs, but we found a lot of microfinance institutions that do take this risk seriously. But they lack a few things. They lack the capacity, they lack the risk management tools, they lack the ability to build products, and really, there's so many aspects of their business model that need to adapt and need to change and need to be supported to change to help their customers manage climate risks. And this is where we see the development sector, the impact sector, impact investors really need to step in to build on existing relationships with MFIs, and to build new relationships and help MFIs transform into institutions that can genuinely help their customers manage climate risks. And this means, there's a lot of it is capital, but it's about different layers of risk-tolerant capital to help them that align with the types of risk that people are facing in the context of the climate crisis. And that kind of risk layering approach, which borrows really from the disaster risk financing community, is something that I think MFIs are going to need to take more seriously and will need support to do. And we're hopeful at CGAP that the funding is there and will be there, and different types of funding will be available through things like loss and damage facilities, right? We think that there's so many different types of capital that are needed, and not all of it is going to have a long-term commercially viable business model. So the ways that we blend capital into this, the way we use grant financing, is also going to be super important. But the key point I think that I want to end is that if you want to get climate finance, particularly adaptation finance and loss and damage finance, into the hands of people that need to do the adapting, so not into governments, not big infrastructure projects, there's no better system out there than an inclusive financial system to do it, right? If people have bank accounts, if people have access to digital payments networks, it's so much easier to get the money to the people and allow them to use it in a way that that is more sustainable, can allow communities to make the investments that they need, and really make sure that the adapting the money gets the people that need to do the adapting. And that's where we think inclusive financial systems are going to play a big role in the climate conversation in the next decade or so.
Thank you very much. I think that is very important, your call to action for impact investors in the adaptation, climate adaptation, because is the part of the finance, climate finance, the lacking part of funding today, and is the most important for developing countries and the global south, actually. You talk about this, maybe particularly changing of the business models and lack of investment readiness, actually, that is not yet there. Maybe on the side of a fund manager that tried recently to launch a specific fund, a specific tool for tackling this kind of difficulties. So can you give us your example?
Thank you, Laura. It's not that we tried, actually, we did. But let me share you more about the experience of Incofin and work. Yes, I do that. Right. So I'm very happy, actually, to share with you the experience and the work of Incofin, actually at the intersection, as you show very well and very nicely in your presentation, between green finance, social finance, and Incofin has been working, investing for impact in emerging markets for the last 20 years, primarily in 3 sectors. We talk about financial inclusion, agri-food value chain, and also access to drinking water. We do typically provide debt equity investment, but also capacity building that you mentioned, Laura, which is very important and part of our impact value proposition. It's also how we try to create additionality through our investment for impact. So this year, in February, we did launch Incofin Climate Smart Microfinance Fund, which is a fund that is addressing the social dimension of climate change. In a nutshell, it's investing in climate adaptation, climate resilience, mitigation through financial inclusion. But maybe what does the fund do, right? I think it's easier to give you an example than to show you the nice rainbow SDG tiles. So we invested a few months ago we partnered with a financial institution based in Nicaragua. The institution is called Fondo de Desarrollo Local, FDL, for the one that know them. So they are working in Nicaragua. Typically, they have 46,000 clients, mainly micro-entrepreneurs, and the vast majority of their clients are actually in rural areas. They live from agriculture, small trading in this area. And FDL is a partner of Incofin since many years, and we have been following the work in the field of agriculture in particular. They have been engaged in green finance since more than 10 years, before it became fashionable in all these Luxembourgish forums. So, because why? Nicaragua has been affected by climate change since many years already. El Niño, La Niña, for the one that work in Latin America, are not new phenomenon. They are accelerating, and they are having more and more impact on the agriculture typically, but these are not new phenomenon. Nicaragua is also very much exposed to another phenomenon, is the acceleration of deforestation. And there, the approach of FDL is very interesting. So they do provide financial services tailored to climate adaptation and resilience, but also non-financial services. So they bring capacity building that allows this farmer to actually to know how to better implement sustainable farming practice. So they bring the knowledge, technology, they build partnership with local experts that help them implement more sustainable agriculture. And one work that we find very interesting is also the work they do in what we call the buffer zone of natural reserve Bosawas and Indio Mas. These are two very important natural reserves in Nicaragua. And many FDL works with many clients in this buffer zone. These buffer zones are very important because deforestation and soil degradation are also affecting this natural reserve. And so FDL is engaging with their farmers in order to implement sustainable farming practice to prevent soil degradation, but also working through agroforestry to make sure that these communities, rural communities, can still make a living from this livelihood, but still can do it in a resilient and adapt also their farming practice to prevent climate change and negative impact on the environment. So you have understood that addressing climate justice is really at the heart of the fund. I don't need to convince you here today that there is a unequal cost of climate change. You can see it clearly on this chart. On one side, you have the adaptive capacity of countries. On the other side of the horizontal line, you can see the exposure index. States the obvious, the low-income countries, emerging market, and are the least prepared, have the lowest adaptation capacity, and bear the biggest exposure, the most vulnerable. And what is most striking is when you look at the financing gap, the needs are today 10 to 18 times the size of the current international finance going to climate adaptation. So the gap is huge, and let's be clear, public finance is unlikely to solve only, it's not enough to just solve this gap. So tapping to private market is critical in order to scale up climate adaptation and to bridge this gap. And most reports about climate adaptation, they point to that issue that public finance is important. I think it was mentioned a bit earlier, this misbelief that climate adaptation is something it's a public matter, it's a government matter, but actually small micro entrepreneurs, they need also the resource to adapt. And it's critical in order to accelerate climate adaptation to be able to provide finance to these MSMEs. What do financial institutions say about that? I will repeat some of the old speech, but I think we are quite aligned. So last year, we did conduct a survey toward our partner investee, 75 financial institutions globally, from smaller cooperative providing financial services to larger banks. And the common observation is that the majority of these institutions are affected by climate change. Okay. And they have really developed a strong climate strategy. They have the intention to integrate climate change into the strategy and to also define clear climate objectives. When it comes to implementation, what we see is that they are still lagging behind. The implementation is not there yet. 43% only track systematically into their system. They have embedded into their system environmental climate elements. FDL, for example, the example I just mentioned, has embedded into all their credit policy clear climate environmental indicators. And what is the most striking element of this research is also that, again, as Waltz mentioned, most of them will have a small green product. But when you look at the scale of this product, we are really not there yet. It's representing only 10%, less than 10%. And that's really the ambition of the fund, is to be able to scale up microfinance. And what we call climate smart taxonomy, climate smart microfinance, and for that we develop a taxonomy. One of the challenges that we have observed when developing and launching the fund is that the language within the climate finance sector is all about mitigation. We calculate carbon sequestration, carbon footprint, but when we start engaging on climate adaptation, there is so many dimensions, so many language that we can speak. And so we started from the existing work and we try to define a much more holistic approach to what are climate smart microfinance. Holistic in the sense that we don't put into specific bucket mitigation, adaptation, resilience, transition, but we look at the ultimate need of the clients. And we, for example, the chart doesn't show super well in the transition, but you see, for example, sustainable agriculture. I give you the example of FDL, but access to water is also a key dimension. We know that affected by climate change, that is affecting also disproportionately typically women. I'm very happy to debate with you after about this question. And so all this dimension is also resilient habitat. How can we make habitat more resilient to heat wave, to floods, to other disasters? These are all dimensions that the fund ambition to address. Voilà, and I think we are almost over time, so I will leave it to you. Laura, thank you.
Thank you very much. I was impressed by a figure that you mentioned that is always is in my concerns, because as ADA, a support organization, we work together with investors and together with mainstream organization as well, in order to strengthen the business model of potential investees, to enable the market to grow and be able to absorb. Because what we mentioned earlier is the fact that there is potential, there is evidence that financial inclusion and financial service providers in financial inclusion sector are the key player for climate adaptation and SDGs in general, but is not yet this scale, because there is not this readiness in order to get this funding. And I was impressed by one particular figure, that is 17% only able to measure outcomes. I think it was the figure, and I would like to ask to both of you about measurement. How you see the potential tools, or do you have in mind a way in which we as a support organization can help better the financial service providers in order to help them in measuring? Because measuring is not just about reporting. Measuring is as well knowing better the way in which we do things, and measuring help in a learning process, how to do better, how to achieve better reach better our client with adapted and affordable product and so on. So it's more in learning and tool and reporting, of course. But yes, just want to ask to you, how do you see that in your experience? You can.
Happy to start. Maybe there are 3 dimensions I think we can refer to when we look at measuring climate adaptation resilience through the fund. The first one is assessing the climate readiness of the institution. That's there exist some tools that have been developed also by European microfinance platform. The green index, the green score, is also part of some other tools that are existing in aligners today, developed by SPTF. And so we do use this green score, which look at 3 dimensions, always the intention, the system, and the product that are offered by the institution, to assess how much advance are there in their climate journey, the climate smart journey. So that's one way to assess the institution. And then what's important is to track how the funding are used, which type of product, and that's where we refer to this taxonomy, which for us is very important to understand how the funding are used, what are the needs, and then ex post, we believe it's very important to partner with institutions that have been able to provide to the market objective means to assess resilience, such as 60 decibel. I believe there is a panel this afternoon with 60 decibel. We have been working a lot with 60 decibel over the last years as well. They have been developing tools to understand the resilience of their client, and looking at several dimensions, not only climate adaptation, but also gender, social, repayment capacity. So it's really a comprehensive approach that can assess how clients are better off served by microfinance product. And that's, I think it's a process that need to feed itself in order to see how can we take feedback from the field and use that in order to design products that are better for the client. And the technical assistance, again, here can play a big role to design the best product for the client.
Yeah, just to add to that, I mean, it's clear that money goes, development capital goes to places where it can be measured, right? Like, we all know that, and we all know that resilience and adaptation is really hard to quantify, and we don't have very good metrics. There is interesting work going on this. Like, IFF has developed a resilience credit, which is, I think, is the way to go on this, to develop something that is, measurable and comparable. But I would also say on this, a couple of things. I think we need to be better as a sector at learning from communities about what resilience means to them, and be more comfortable using qualitative data and make those investments in qualitative tools that help us understand how resilient a community is, using its own measures and not try and look for internationally comparable quantitative elements. And secondly, I think in a situation like this, where we're talking about things that we may not ever have metrics that are as good as some that we have for carbon reduction, is be more willing to make investments where we aren't going to we know we're not going to have that final quantitative metric at the end of the day. Be more willing to lend on or to invest on what we think is a solid theory of change, and we have a good sense that it will help without the need for those concrete results at the end. Because if we're waiting for them on climate resilience and adaptation, I think it's going to slow things down so much.
Maybe there are some questions. We have some time for questions? More or less. Okay. There is 1, 2.
I'll just grab a microphone so that people online can, yeah, there we go.
Meet you in the middle. Thank you. Yeah, thank you very much for the talks. I'm Stephen from SustainCert, a certification and auditing body of impact. And it was really interesting to hear how the two topics came together, of course. And I guess my question is the role of individual corporations in financing financial inclusion. And the reason why I asked that is because your two talks reminded me of something we've been working on relatively recently in India, where corporations wanted to affect climate mitigation projects, to have lower impact cotton, where half of the world's cotton comes from, the smallholder farms there. And they wanted to do this, but they realized the way to do that was financial inclusion, because many of the smallholder farms were culturally excluded from finance. And it's been well documented, there's, over the last 20 years, many suicides, because they're unable to gain the know-how, the equipment, in order to become more engage in more regenerative farming, in order to adapt. So it was very much the financial inclusion that was the lever for the climate outcomes. And yet, it took a few corporations, who are often seen as the bad boys here, to club together to identify that need and finance them and their transition to regenerative agriculture that increases their resilience to yield volatility, drought, flooding, etc. So we're talking about impact finance here through funds, but it's quite interesting that individual corporations are finding the solutions as well themselves. And maybe there's, so I guess, do you have any comments on that role and the aggregation of different sources of funding in this respect?
Yeah, just quickly come back on that. We actually have a paper coming out very soon where we talk about what we see the development sector, the impact sector needs to do in this space. And we've got the kind of the categories of information. And obviously we're talking about capital. How do we get capital to these places? How do we help them manage risk? How do we help them build capacity? These are like the buckets of intervention. But one that we're also trying to bubble to the top is about coordination, right? Because you've got all these low-level adaptation strategies that might conflict with each other, and there's the risk of the tragedy of the commons happening there as well. So the coordination between people trying to adapt is also a really critical part for this, that we see the development sector would naturally play a role in. But yeah, in situations like this, I can, at a pretty commercial value chain like cotton, I can fully imagine that there could be commercial entities playing that coordination role as well.
We have another question here.
Hi everyone, thank you very much for this very interesting discussion. I've arrived yesterday evening from the 4th largest island of the world, a hotspot of the biodiversity and one of the poorest countries of the world, Madagascar, where we've been investing for almost 9 years. As an impact fund manager, we finance 16 companies, microfinance, energy, retail, agriculture, and as a blended finance program manager funded by donors, we have financed almost 50 companies. Definitively in Madagascar, there is a strong thesis for financing companies, SMEs, that will offer job, alleviate extreme poverty. We have 80% of extreme poverty in Madagascar, less than 500,000 jobs among a population of 30 million people. It means less than 2% of the population has a formal job. It's pretty the same around Mozambique, Tanzania, less that pity, but pretty the same. So the thesis, there is definitively a thesis to finance SMEs in area where local communities are extremely vulnerable to climate change and rely on nature to survive on a daily basis, and thus make the problem even worse because they just take the tree they have around to survive on a daily basis. So there is this thesis to finance SME in agriculture, in nature-based solution, renewable energy, and so on, that will give decent job, create more wealth, if we can say it's wealth, around those areas. But the problem is that the company are not only, we all know that, and you've emphasized that. We've emphasized the fact that the company are not investment ready. They are not only not investment ready, they are so few. Where we live, the SME, they are just not investment, not ready. They don't exist. We can find dozens of them in some regional area, but definitively I'm not sure there is the room for dozens of impact investing funds in that kind of geography, because the company doesn't exist, the ecosystem is not ready for the entrepreneur. So in this kind of situation, I'm not sure our industry is a very recent one, and we have innovate a little on doing blended finance at the fund level, and it's pretty accurate. What I see on the field is another interesting trend, is doing blended finance outside the fund by doing a strong collaboration between development actors, mainly donors, large international donors, conservation actors that will prepare the field for impact investing funds such as we are. There is a figure in Madagascar. We've invested in 15 companies, and we've support 3 times the number. We've used USAID money, GIZ money, French Development Agency money, GCA money, in order to identify on the field, reinforce in a very longer term perspective, company that will never be investment ready, never. But doing so, we are fostering an environment, and among the dozens of companies we will finance, we will have perhaps the future champion in which we can invest in. My problem is that as a fund manager, when I go to IFC, Proparco, and we talk a lot with them, to raise money for my blended finance fund, they see what I do outside the fund as a diversification, if not a dispersion. And if we continue doing that, we will never be able to finance real company, real entrepreneur on the field. Thank you.
Thank you. Well, that's a very powerful statement. I'm not sure if there's any feedback you would like to give. It was
Not sure what was the
It was
question.
more of a statement on the ground and the experience, the lived experience, I think. Do we have, yes, we have a question
Yeah, but
here.
if I may just react, maybe.
Yes, of course.
I think it's interesting feedback in this, because you mentioned that some investment are eventually not investment ready yet, maybe from international investor, institutional investor in Luxembourg. From that perspective, it may not be investment ready, but again, through financial inclusion, that company, SME, may be investment ready. And that, I think, also the beauty of financial inclusion is to be able to invest into the MSME sector, which you cannot achieve as impact investor by yourself from a risk perspective, and that achieve the diversification. We have seen and heard much more innovative structure of blending at the level of the investment, and I think that's something we hear a lot. But the challenge I see there, and that was also mentioned in the previous panel, is the scale again. And that's what we need, investing directly into cooperation. We do it through an agri-fund typically, but that's also funds where we can not achieve the scale that you will see in the other funds. And what we see today, maybe just a concluding word, is that when we talk about financial inclusion, we always have these 1 billion people excluded from the financial sector. But when we talk about people that are vulnerable to climate change today, we talk about more than 3 billion people. And they need funding to adapt. And I think that's why it's important to work through financial inclusion, because we will never be able to reach and scale their adaptation capacity otherwise.
So we have, if we can have, I know there's a question here. It's obviously a very popular panel. It is lunchtime, so if anybody wants to sneak out, no shame. You can sneak out and have lunch, that's no problem. And for those, if the panel don't mind, we can spend maybe another 5-10 minutes. So.
Yes, hello everyone. I will be short, I promise. I would want to react on your last point. You said that we should invest into projects where we have not definitive metrics. Basically, we can't measure. So and where we have the sense that it's making an impact, if I got it correctly. How do you basically get this sense? Does it come from experience, communication with local communities? And also, I'm working in climate and environmental risk management. I'm more interested into, in this case, how can you measure risk not measure, but how can you get the feel of risk assessment and measuring the risk? Thank you.
Thank you. No, it will work.
Was one of the just to react, because we share some frustration, and I think that we have to be aware that impact finance is not the silver bullet. It will never be, and this is the reason why we have to count on continuously on the ODA, on the donor side, in order to support, and collaboration on that side is very crucial, in the sense that we have to follow the trends of the market. We have to discuss with investors in order to understand what is needed, and in order to create this enabling environment to grow with the private sector in difficult situations like Madagascar. That is not the only one. I would say we encountered them and we struggle to do them, but it's important to collaborate. I think that collaboration is the main point.
We have a question.
Yes, no, I actually just wanted to add, I work with Graine de Vie, and what you said is that we have the development actors and the conservation actors working together. This is where also the finance, I find, is lacking. We're on the ground working and have conservation projects where we have the highest impact, but we lack receiving funds. And this is, I think, the main aspect of climate change if we want to have a difference, and adaptation. all these partners need to be put together. So thank you for bringing that up.
Thank you. Okay, I will make this the final question, because otherwise people are too polite and they won't leave for lunch.
Thank you. It's quite interesting discussions we are having here. And just a follow-up to his comment, and it just beats my mind, right, how thinking through there are various interventions happening targeted at impacting the underserved or the less privileged or poor communities from different angles of financing. When all is said and done, we are expecting scale. My question then is, why don't we get all the partners together at the onset of the initiative? Because most often than not, the partners intervene at different levels. A clear example, maybe an impact investor going to Madagascar, create an environment for entrepreneurship to thrive, but that funding is quite limited, right? But when that entrepreneurship venture has been identified, you then have commercial banks available, happen to tap in and help these businesses scale. Yet again, maybe their funding would be limited. You then have development banks or philanthropists coming in to help them scale further. But because each of these partners are coming in at different times, but not really privy to the onset of the project and its future objective, intervening might have some resistance. But if from the onset of such a project in Madagascar, all the partners are identified, brought into the drawing board from the onset, and then helped on at every intervening point, we should achieve scale in a very shorter time as opposed to the long tenors that we have. Thank you.
That was a wonderful comment to end on. Any final thoughts from the panel?
Thank you very much because as we passed 15 minutes, so thank you for your interest. I think that this collaboration, coordination is maybe the final word with which we want to conclude this panel. Thank you very much for our speakers. And we can take advantage of the lunch to ask questions.